What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is June 25th of 2020. Well, folks, I hope you are having a fantastic day wherever you are. And in today's video, I not only want to spend some time to talk about the dip we had in Bitcoin's price down below $9,000, but outside of that as well, continue to talk about the strength we're seeing in a variety of key altcoin plays throughout the market. And last but not least, talk about the macro picture where through a variety of charts and data points, we're starting to see that we might be turning in for the second wave of pain going through equity markets and the broader global economy. It's something that's important to keep an eye on, so we're going to be talking about all that and more right after our quick sponsor. Our sponsor for today's episode is Ledn.io. For those of you holding Bitcoin and digital assets long-term like myself, why not put it to work? Ledn works with Genesis, the most established institution in digital assets, to give its retail clients access to a suite of institutional-grade services to manage their digital wealth. Their savings accounts let you earn the best risk-adjusted rates on your digital assets, like 8.8% on your USDC and 4.1% on your Bitcoin. With their B2X service, you can double the amount of Bitcoin you own through a Bitcoin-backed loan, and you can get dollar liquidity without selling your Bitcoin through their Bitcoin-backed loans, much more tax efficient than selling. Get a 250,000 Satoshi bonus if you register with the link below and get a loan today. Alrighty, everyone, so let's go ahead and start by taking a quick look across the board for cryptocurrency markets. As we can see, not only are the top 5 to 10 plays in the red here, but the vast majority of cryptocurrency markets as well are in red territory. Now, the important thing to note here, right, is obviously we want to spend some time talking about the Bitcoin correction, but I do really want to emphasize the divergence we're seeing from the traditional trend. Whereas altcoins usually sell off worse than Bitcoin during these sell-off periods, we're starting to see an opposite picture as altcoin dominance starts to gain ground and again breaks through that significant level we talked about yesterday. And we'll dive back into this topic in just a moment. But I want to go ahead and talk about Bitcoin here. I know obviously people are cautious and curious about what's been going on in Bitcoin markets. So if you guys can't see it clearly on the chart, I'll just go ahead and zoom in a little bit. The bottom here was down here around 8,975, so slightly below 9,000, right? Generally speaking, can be seen as a bounce off of the 9,000 even level, right? This has been a $720 correction from the general range up here where we were getting resistance back here on the 22nd of June. In just a matter of a few days, 3 days really, we've basically gone down $700 on Bitcoin, luckily rebounding about $240 back here at the current moment of what we're talking, right? So again, nice rebound here in the sense of price, but again, hitting consistent resistance at ranges that we've already seen here. And the big thing here to take a look at in regards to the daily is that, for example, if you were looking for that ascending triangle like we were, this is a very clear sign here that we've not only gotten rejection here, but we're also turning over. So again, unless we can hold this general support range here, and if we really start to have a substantial close below below 9,000, I would say that we're probably in for around 7,800 here. We're going to come back down to this general support range that we've had multiple times here, and they'll act as resistance, and then support over here, and support is again, and resistance over here, right? So that's the kind of key thing here we want to look for. As you can see, price correlates a lot around this level, and it might be important that before we break out here, right, taking a look at the very long-term chart, and just being realistic with you guys, I don't want to be overtly optimistic. Taking a look here at the Bitstamp chart, right? Go to the weekly. It might be important that we get a different scenario than what the optimistic scenario would be, where we break out here, again, teeter on this line of resistance, make it support, and then go upwards. It might be that we have the more kind of bearish case scenario, where we come down, set a higher significant low, right? This was our last higher significant low. Set one up here at a general support range of what we saw back in the past. We don't come back here to the line of support, signaling that bulls are coming in, they're taking in the favor of the market here. They're starting to buy in at a higher general support range. And then after that, we get the breakout as we get closer to the tip of the wedge here, going into August or September, right? That might happen, right? Now, I know that seems very dull to some people. I know we've been kind of tired of seeing Bitcoin pushing this wedge for a very long period of time. It's been going on since 2017, since the peak. And again, the support range has been building up from even before the previous bull market ended, right? So this is obviously building in for a technical formation of grand proportions whenever it happens, right? In the meantime, though, it doesn't mean that you have to be sitting on the sidelines. It doesn't mean you have to be, bored of cryptocurrency markets. There's a lot going on right now, guys. Sure, it's not always happening with Bitcoin, right? I love Bitcoin as a project, and I love Bitcoin as a cryptocurrency. But there's a lot of other great things going on right now. And if you're not paying attention, you can miss out on not only a lot of awesome opportunities in the market, but a lot of the exciting innovation that's going on that actually is really pushing for the narrative of crypto outside of just hodling. I think that's pretty boring at the end of the day, to be fair, guys. I think we need to focus on what this space has to offer to the world. And quite frankly, there's a lot of different plays that are starting to showcase reflection of market dominance for altcoins, right? So again, taking a look here at altcoin dominance, we talked about the other day, the multi-week level of resistance that this line was providing, similar to how it did back over here twice in the past. Third time's a charm, we broke through, and now it's looking like we very well might come through, test up to this line, probably hold here for a couple of weeks, and then eventually break through sometime going into the summer. We might get a precursor or an early altcoin cycle for the general altcoin market, rather than just waiting until Bitcoin revisits back to its all-time highs. Market dominance has been shaping up quite nicely here, right? On the longer term trend, right? Since back here in September when we flipped, right? When we got the first significant drop here, we started to take a position in mid-September that altcoins were going to be here to stay and start to gain market dominance. And so far, it's paid off really nice in that sense. We've increased our Bitcoin portfolio by a pretty long shot here, and something that many people wouldn't even deem as an altcoin cycle. But it's about finding those key plays here, because you don't need much market dominance gain for a lot of the small to mid-cap plays. They're actually doing something, right? I'm not talking about really just straight up hype here. I'm talking about interesting projects. Like Kava, for example. Kava's one we built a position in back here around 11,000 Satoshis. Kava is basically doing what MakerDAO's done, but it's working cross-chain and bringing in a variety of different assets in order to build basically stablecoin liquidity in this case, to be able to issue, in this case, basically cryptocurrency credit off of cryptocurrency collateral across a variety of chains. So rather than MakerDAO, when it was just Ether or maybe ERC20 tokens, even maybe real world assets that are ERC20 tokens, this is one that's going cross-chain and bringing in a variety of cryptocurrency assets, which I think is really cool. It also makes it easier for people to be able to collateralize their loans in this case. Just the simple fact that I don't have to stick to Ether and ERC20 tokens. It's a very big value proposition. Outside of that as well, RLC, again, one of the major plays in the Oracle space, as well as a lot of other distributed or decentralized systems. Again, we got in, I think, back here around, I think it was a little bit before the breakout here, around 5,800 sats, and traded through the breakout here. We're doing really nice on RLC and also Tomo Chain as well. This has had a really nice technical build up here, looking like it's going to probably break out as it goes about 5,400 sats and kick off in the next cycle. And these are just a few of the plays, guys, right? The more technical plays that I'm a big fan of, such as Ren VM. We got Ren on the list here. There we go. Ren still holding up towards its new all-time highs here, looking like it's going to be going back up here to test this line against the 2 points of previous resistance here around 2,200 sats. KNC, Kyber Network, still holding the vast majority of its gains, looking like it's building into a ascending triangle. Now, again, this is the technicals, guys, but the fundamentals are incredibly interesting. Apologize for that, guys. I think I need to have a little bit more water in the morning before I start my videos. But speaking to that technical traction, right, it's important to look at ETH transactions. It's important to take a look at the networks that these applications, these tokens are utilizing, because you'll get a good picture as to what's going on here, right? So the first thing we need to consider here is in regards to the actual data points, right? So, right, we've got DeFi at all-time highs in the sense of assets under management, right? This is the total value of DeFi applications. Compound now becoming the largest protocol. Maker, second place, and also Synthetics being in third place. Aave as well, close fourth place. And Balancer, pretty nice bounce up here for a new project on the block, right? So we've got all this stuff here. Also more Bitcoin and wrapped Bitcoin than on the Lightning Network. Keep that in mind, right? So if this doesn't show you DeFi's got some traction, DeFi is killing it. You've got stablecoin liquidity practically doubling in a matter of a couple of months here. And this is proving here we're almost at $10 billion for Tether alone. This isn't even including that, USDC was just leaped up $200 million, TrueUSD, Paxos, stablecoins for, precious metals like gold. Again, there's all kinds of new assets that are moving on to the cryptocurrency space, and no one's talking about this. And above all, with the new move of Tether, with the move of all these different types of stablecoins into the market, and also these DeFi applications that are requiring more complex types of transactions to be conducted, therefore costing more gas and raising up gas prices. Since back here in March, right, we have seen a major shift, right? Excluding the anomalies here, right? We've seen a general broad shift here from around 8 to 10 cents per average ETH transaction, which already is kind of expensive. I'd like to see the fees lower than that. All the way up here to 74 cents, practically a 7 to 8x here, depending on what exact base you're working on, right? A 10x in gas fees. This is not sustainable. But it does show you here that there's demand here. So there's pressure now for Ethereum to start to scale up in the long term. And we've got to start to see not only layer 2 solutions be implemented by a variety of providers in the cryptocurrency space, but most importantly, we need to see ETH 2.0. We need base layer scaling until we can make those layer 2 solutions practical for people to take on. Right? And a lot of them are working, but it takes time to get these implemented in systems. So again, you've got a lot of different things. USDT, DeFi, definitely playing a role here. You've also got, again, some people who are probably abusing, and this is probably tied to the Plus token Ponzi scheme, some people abusing, paying high gas fees in this case and laundering through the mining system for Ethereum. I'd really like to see some protocol updates implemented so this can't happen. And predominantly one of those is one of the EIPs that's talking about a new structure for the gas fees for Ethereum. We need to get that implemented as soon as possible. We need to get ETH 2.0 implemented as soon as possible. I can't stress it enough, guys. If this doesn't happen here, a lot of DeFi will be stunted in its growth. And I'd really like to see this thing, basically come to full fruition. I want to see DeFi expand. This is going to offer so much opportunity to people across the world if we can do this properly. That's the key thing we have to make sure. We have to make sure we can scale, that we can make things private, that we can make things practical for the end user. And luckily, the user experience is getting better for DeFi. We've tried to do a lot of things in regards to Digifox and stuff, just making things as smooth as possible. But again, I want to keep in mind here that there's a lot of great innovation here, guys. So don't miss out on it. Again, be open to it. I understand we're all crypto freaks over here. We don't really care much per se about stable coins, and we don't care about things that tie to the dollar, traditional systems. Yes, that's true. But for the average end user, in order to bring this next wave of people into the space, the best way we can give them access to digital assets, the best way we can give them a yield on their money, the best way we can give them a frictionless, censorship-resistant payment network is by letting them come in through the door through a stablecoin first, giving them that on-ramp from their traditional bank, getting them out of the traditional financial system, taking away all the control from traditional corporate banks who don't have the interest of people's money and their well-being in mind. Well, they certainly have the interest of the person's money in their mind, but they don't want you holding it. In fact, they'd love to pay you nothing for your money. That's the key goal of a bank, is to pay you as little as possible and charge you as much on the other end when you take out that same dollar in a form of credit, or your best friend or your family members through predatory loans or predatory rates. So anyways, rambled on enough about crypto here. But as you start to move into the crypto space, guys, again, whether you're exploring DeFi applications, whether you're making cryptocurrency trades, maybe you're trading some of the DeFi tokens here, it's important to note that, of course, there's tax season and stuff. Tax season, of course, has been extended. So if you guys are still rushing to get a close on your taxes, check out TaxBit. They're one of our sponsors here on the channel here. They aggregate all your taxes into one single document that you can ship off to the IRS, and all the documents that you need and stuff in regards to cover for income, in regards to your cryptocurrency trades, your cryptocurrency, lending operations on a lot of different platforms like Celsius, which we offer in Digifox. So again, check out TaxBit. I think you guys really like them. They've been one of our long-term partners on the channel. Great software application. Now, I want to go ahead here and talk a little bit about the macro perspective here and talk about starting off with Raoul Pal, because Raoul, just like myself, is someone who really likes to look at the boring markets, and that is the bond markets. It's no wonder it starts with a B, because it is the boring markets. Now, I don't even hold any bonds, guys, to be completely fair with you. But as much as I don't own any bonds, they are probably the most important thing you should watch if you want to know where the stock market is going, if you want to know where Bitcoin is going to go, if you want to know where gold and silver are going. Because bond yields are a perfect precursor. They are a telltale sign of what the Fed is going to do with interest rates in the coming future. The markets always know ahead of time. You and I, guys, let's be fair. We can know what's going on to a degree. We can see what's going on in the headlines. Hey, we may even have a connection or two in the world of finance who've heard a thing or two here or there. The markets, in many cases, especially bond markets, are highly efficient at understanding what the Fed is going to do. no matter what Jay Powell says, no matter what fancy terminology he or the rest of the Fed say, you can get a good idea of what the Fed is going to do next if you watch bond yields. Taking a look at the 10-year bond yield, consistent uptrend here, going up from a basis here of around 0.6 here. So basically in every year, you're now earning about 0.6 on the bond, right? Going up here to 0.68, right? Selling off the majority, or not really per se selling off, losing a lot of the yield here. And looking very much like if there's a slight dip below here, that we could easily break below this, lose any of the gains that we've had here since back in April, in the sense of the confidence that the Fed is not going to be lowering rates, and that it is probably going to be that the Fed goes to negative rates. That's the key thing here, right? It's not exactly what bond yields are for. Bond yields are what you earn on a bond. But on a logical basis here, if the Fed is going to reduce the cost to borrow capital even lower, bond yields are going to go down because the price of the bond goes up, and therefore it tends to be that when the bond price goes up, yields decline even further. So if you're a short-term trader and you want to take a net long position on bonds, heck, it might be a great time to start looking at that, right? I'm not going to tell you guys what to do, right? I'm just saying that on a logical basis, I hope you guys see what I'm saying there. It's that the bond price is going to continue to accelerate on this already crazy bond market that we've been in if the yield drops, right? Even if it goes into negative territory, price still goes usually up. It doesn't make much sense. It's la land, guys. The bonds shouldn't be going up in value. The yields shouldn't be going down that much as well into negative territory, but it's the world we live in. Rob Paul also mentioned as well, the other two interesting charts are other bond charts. Taking a look here at the 5-year bond yields. Pretty much a flat line here since back in 2020, right back in March. And looking like it very well might come down, smash through there, and go down to 0.2, 0.1, and possibly down to 0, right? Last one here, 2-year. 2-year yields, same exact scenario here. All bond yields are holding on a cliff here. We saw this exact same pattern in the price performance of European banks back before all the craziness that's happened in 2020. We saw this back in the fall and the winter of 2019. Banks were teetering in Europe, already due to negative interest rates, and they closed right through and now are in the worst territory they've been in a very long period of time. So, as Raul mentions here, when the break comes, it will be the signal of a shift of regime back to the underlying macro perspective, right? So everything that's really going on in the world is going to start reflecting in the general markets. It's going to showcase here. It's a very clear sign through the yield itself that the Fed is going to have to go down to negative interest rates, that the market is in a state of panic, and likely could be where we start to see a dip in equities. So moving on here to some interesting data points here. I want to talk about setting up the world for a very, very disastrous position. We've already talked over the last 2 years about dollar-denominated debt. And for those of you who are hearing about it for the first time, this is basically, for example, you might have heard about the currency crisis in Turkey or Argentina. A lot of this is caused by Argentina or Turkey taking out a loan from foreign governments like the United States in terms of dollars. Now, why is that important to note versus just taking out a loan maybe in their local currency? Well, the importance is that if I take a loan out in US dollars, let's say I'm Turkey, and on an annual basis, I'm taking out a loan from the United States in the form of 100 billion US dollars. So my loan on dollar terms is $100 billion, and I owe some kind of interest rate. We'll just negate that for now. The key risk here in the dollar-denominated debt is the principal. Because if my base currency, the Turkish lira, which is the normal currency that people use in Turkey, loses half of its value, let's say there's a geopolitical crisis, or maybe we've printed a lot of our own local currency, like Turkey has. Well, what happens is the purchasing power of my currency goes down in half, meaning that the currency pair basically doubles in this case. A dollar can buy twice as much currency as before. So, on a practical sense, I have to get twice as much lira. Okay? If I'm a saver, I can basically buy half as many dollars to pay down my debt, right? So you have to work twice as hard to pay down your dollar-denominated debt. And the larger amount the dollar-denominated debt goes, and the lower your currency pair goes, the more impossible it becomes, and the more almost enslaving that debt becomes to be able to pay back. And this is the exact reason why Turkey had to enter into a state of hyperinflation, printing its currency to levels that it hadn't seen in a very long time, in decades. The inflation rate was insane, and it led to a lot of people losing their life savings, or really, on paper, it looks like they still have their life savings, but the purchasing power goes down. The prices of the goods and services they need to buy, going into their retirement, going into their everyday expenditures, is increasing. And now, whereas we saw a decline in US dollar denominated debt back here since 2014, 2013, my apologies. Again, we had seen this nice healthy trend going into 2016. We're now back on the cusp of more debt, more risk taking, and sadly, more exposure to US dollar denominated debt. The world is becoming ever more exposed to the dependency of the United States. Taking a look here at equity markets, if you think what's going on is unhealthy, you're probably not wrong. The more long extended form of the FANG acronym, so Facebook, Apple, Amazon, Netflix, Google, and Microsoft, major tech companies, many of which are over $1 trillion, are now dominating an ever more share of the market than they ever have in history. Take a look at the broader performance of the S&P 500 x these companies, right? Taking out these companies. The total as well, right? This is absolutely insane. Now, to be fair, these companies, there's a reason they're so large. They are ever more relevant in our lives in a post-COVID world. They are very clearly tech giants across the world. They have global dominance in a lot of ways. But this is absolutely insane. The kind of vertical rally that these companies are having. Can it keep going? Probably. So long as the Fed enters into negative interest rates, so long as we see another round of QE, possibly the Fed finally getting to the point, even though it said it would never probably do it, of buying equities, buying ETFs, buying up the Qs that are overexposed to these tech companies. Who's going to bet against that? Right? And the Fed can do it for some time until it stops working. Now, there's one thing I want to point to that's quite interesting here, guys, and this is something that makes me really excited for not only what we're doing at Digifox and stuff, but generally what's going on in the cryptocurrency space. The household savings rate is expanding at a rapid pace. We are now starting to see a massive curve here going into 2020 of the savings rate, not just in the United States, but across the world at a variety of countries, starting to spike. The actual savings rate in the U.S., right now, I think an average person went from having about $1,000 in their savings to $3,000. People are parking capital. They're not spending it. They know that the environment right now, what we're in right now, is one that's excessively risky and one where, again, excluding monetary policy, thinking about all this, we're just in a very volatile environment. If you take a look at people's travel plans, if you take a look at all the kind of frivolous things people do in an optimistic market, all of that has retraced. And I think a lot of people are going to look for a way to not only get a better yield on their savings, something that's relatively stable, but outside of that as well, they're going to look to get exposure to a wide range of new assets. And predominantly, if you're talking about the younger audience out there, whether they have $1,000 or $2,000 to their name, only a few $100, or maybe a few grand, maybe they have a good substantial amount of savings, I think a lot of them are going to start turning towards the asset that we've been watching for a very long period of time. And that's Bitcoin and cryptocurrencies alike. It's becoming more and more accessible, guys. I'm telling you all, no matter if it takes 3 to 6 months, a year, or our peak target of November of 2022, so 2.5 years, it's going to come. And patience is going to pay. All right. So anyways, guys, I hope you are having a fantastic day wherever you are. I appreciate you listening to me ramble on today. If you like this video, please consider dropping a like. And also, not only consider subscribing and hitting the bell icon so you guys don't miss another video, but I'd like to hear from you guys down below in the comments. What do you think about what's going on in the macro environment right now? Are you guys feeling like we're on the upswing here, right? We obviously are starting to see some signs of recovery here. I mean, there's a lot of room to recover when you shut down the economy and lose 25% of GDP. We don't doubt that whatsoever here on the channel, but I'm curious to hear, do you guys think this is going to be substantial? Do you think the Fed has some sense of control over this? I'd like to hear from you guys and get a discussion going in the comments. But outside of that, I'll see you all in the next video. Stay tuned.